Well, hey, I'll just start talking. This is Rick Ormsby here. You can probably see my ugly mug and shiny head. I'm kind of easy to see from a long distance. And you got Mike James here, obviously, and Reed Melillo too. Say hi, guys.
Hey, guys. Afternoon.
Yeah, we're excited to be here. It's an honor that you guys have taken the time and chosen to do this with us. And we'll just kind of hang out for a little bit. It's Central Time here. It's about 2, so maybe we'll wait just a couple of minutes. In the meantime, I guess this is our second webinar that Unbridled Capital has done. The first one we did was on estate planning about 3 weeks ago, and it went really well. This one is obviously about COVID-19 and the impact on the M&A market going forward and in the current environment. Wanted to make it both a discussion about businesses, but also a discussion about real estate too. And so we'll do that. And then we've got a third one coming up in about 2 weeks, which I think you'll find interesting, which is going to be on business interruption insurance. And I've been speaking with a Harvard-trained national expert in the area who has tons of expertise and experience here. And he thinks that this is the next big shoe to drop once franchisees get past the P3 lending fiasco that's been going on over the last couple of weeks. Because as you know, a lot of these business interruption insurance policies are going to immediately decline and deny, and there's going to be a lot of litigation. Think back to Katrina and all the litigation that happened on the Gulf Coast because of the hurricanes. So that's going to be coming in a couple of weeks. And if you want to see or get attached to that, all you got to do is go to Unbridled Capital's website, unbridledcapital.com, and you'll see a little, orange or yellow button up at the top. So you can hit on that and you can join in and get the information. So and then subscribe to our email list and such. Okay, so maybe we'll just give it another minute or two. Attendees are still trickling in. Pretty cool, Mike, Reed. I mean, a lot of people here, and I imagine from all over the country. I mean, I'm in Kentucky. Actually at the moment I'm not, but I'm usually in Kentucky, and these gentlemen are in California. So we got people all over the country. What do you think?
Yeah, it's awesome to see. I know I've had a lot of texts of watching my phone of people that we know getting on, so it's exciting. We couldn't be happier to be a partner of Unbridled, and it's a crazy time, and the more information you can get, the better. It's important to hear from as many professionals as you can, and I'm continually learning in the same capacity. So very excited to be here today.
Yeah, it's awesome. It's awesome. Well, I'll go ahead, I guess, and maybe start. I mean, the numbers are still trickling in, but I guess it's probably as good a time as any to start. We'll try to be respectful and keep this to an hour. The goal is going to be 45 to 50 minutes and then some Q&A at the end. So if you look at the webinar chat at the bottom, you are able, if you are using the functions, and why aren't we all figuring this Zoom thing out, but you're able to send questions and commentary to us, the panelists, personally. It won't go to everybody. And we'll monitor and keep an eyeball on it so that if you have a question, we may or may not get to it. Please also know that at the end of this, we will send you an audio of this webinar and the presentation that we're going to be giving as well. So you'll have that for your records. And then if you have any questions at all, you're going to know how to get in touch with us. A lot of people on this call know me really well and have been friends of mine and clients of mine for a long time. So if you have any questions at all as we get off of this call and off this webinar, just please reach out anytime. The same to Mike and Reed. I know they'd be happy to help you. So right now I'm going to share my screen and we'll go ahead and fire away. Okay, so here we are. This webinar is the second one that Unbridled's done, like I said a little bit earlier, and it's called Franchise, M&A, and Real Estate Market Conditions in Post-COVID-19. It's been a crazy one out there for all of us, I know. And so just to do a quick introduction, most of you again know me. I'm Rick Ormsby. I'm the ugly dude from Kentucky on the far left there. I've been doing this for 15 years or so after leaving Yum Brands in the early 2000s. I've got a 10-person team in Louisville, Kentucky. We do franchise M&A work. We help people buy and sell and recapitalize their businesses. And I guess the thing I'd be most proud of is just to say that, over the last 3 years, we've closed about $1 billion of restaurant M&A work, and we've done it at really almost close to a 95% success rate, which is almost unheard of in our industry. And you're going to see Mike, James, and Reed Melillo. I maybe just let them just quickly introduce themselves, but these guys are from the California area, down in Southern California, and they've been a partner of ours now for a couple of years. We've done a couple $100 million of work together, and they have done a lot of the financing, buyer financing of the real estate on the transactions we've been involved in. And they've also helped a lot of our clients monetize some of their 1031 proceeds from business sales and to put them in passive investments that are diversified across the country and across different types of real estate. So we've been really happy with them. You guys want to just say a quick hello and what you are and who you are and that kind of stuff?
Yeah, certainly. And we've been working together for, I think, six years directly now. We've been in the business for a decade, so not quite as long as Rick, but we have a group based in, and for those of you that know Los Angeles well, in the Westwood area, we have just over 50 investment professionals, primarily focused on the execution of single tenant net lease transactions throughout primarily the United States. We've done some work outside recently, but I head up the M&A real estate team. That's my focus within the organization, in tandem with Reed, who's also on the call. And we focus on executing, sale leaseback transactions, structured financing, and basically maximizing value in terms for any real estate relations to M&A.
Yeah, appreciate it. Yeah, thanks for the introduction. And hey, by the way, Mike, nice flowers in the back of your thing.
Yeah, that's my wife. My wife came over earlier and moved a bunch of stuff around. She's like, "You can't have this." I have newspapers and books and stuff all behind me, and she even got me a better glass. I had a plastic glass this morning, so.
That's nice. I tease, I've got a virtual background, so no one can see exactly what I got going on in the background. It's not too bad, right? But all you see is a virtual background, but it gets kind of creepy too. So we'll jump right into it. Our discussion today is going to really center around a couple of key points. Number one, M&A market conditions right now. We're going to talk about that. I'll pick that up, and then I'll kind of give you some of my views on what's going to happen post COVID-19. From my standpoint and from Unbridled standpoint on the M&A side. And then Mike and Reed will jump in with the real estate market conditions currently, and then what their views are similarly on the real estate side. And I'll ask them to talk specifically as it pertains to retail M&A and kind of work in the business that we're in. We'll do a quick Q&A, pardon me, and then we've got a couple of questions here that have come in off of email, and maybe we'll also trickle in too that we'll try to address towards the end of the presentation. So I'm going to presume for a minute that there's hundreds, if not many people on this call, and some of them are going to be not restaurant people, right? Maybe more real estate people. So be patient with me as I kind of talk about the current franchise environment if you're a friend or a client that already knows a lot of this. But clearly COVID-19 has had a lot of challenges, right? Has presented a lot of challenges across the retail sector and in the restaurant business particularly. I'd draw your attention over to a directional graph over to the right. It's not meant to be precise or exact, right? It's meant to be directional, and it was really intending to be the first couple of weeks of the COVID-19 crisis. But directionally speaking, you could kind of see what's happened to the different segments within the franchise space. You've seen QSR down roughly 40, fast casual down roughly 50, and then, somewhere in the casual dining realm between mid-scale casual dining and fine dining, we're down somewhere between 70 and 82%. Clearly, we have a lot of the fine dining and casual dining restaurants just closed. I have a friend who's a Denny's franchisee who just told me anecdotally he thinks about a third to 40% of the Denny's restaurants, as an example, are actually closed across the country right now. So restaurant revenues are down quite a bit, but within these numbers, you have some signs of positivity, and it's not a blanket thing. So we have seen, I guess we saw Wingstop just report, and their sales are huge right now. I think they're plus 9%. We have a client who's a big Sonic franchisee where, we're selling his business. He's got a big Sonic business, and he's got year-over-year same-store sales since this started that are only down a few percentage points. And then we have a Papa John's client, a fairly large Papa John's client, who's been showing same-store sales increases in his markets. And if it wasn't for the NCAA tournament not happening, it would have even been stronger. So we have a little bit of a reordering here. But so you have the concepts like Domino's and Papa John's and Sonic and Wingstop that have really been outperforming, in many cases been doing better than they were prior to the crisis. But generally speaking, most of the tier one drive-through QSRs have been down between 15 and 30% since the crisis started, and they have been trending upward. And I'll talk about that in just a little bit. Casual dining and fast casual has been struggling a lot, right? It's not a surprise to see when you just drive down the street in your hometowns to see that a lot of the locations are closed. They don't have a drive-through business. They've been struggling to get off-premise sales. And large permanent closures are expected. A lot of pundits in the market are saying 10 to 20% overall restaurant closures, which is a shocking number. I'm kind of on the light side of that, maybe a little more optimistic, and I think maybe a 10% overall long-term closure of the restaurant business is possible. I'll tell you, I think, over the last couple of years, we've had GDP growth that's been 1 to 2%. You've had same-store sales growth that's been flat, and you've had new restaurant units being added to our economy at a 1 to 3% clip. And you can't do that forever without dropping transactions, and transactions have been dropping in the industry, and the only way we've been getting sales across the industry is by having pricing at the expense of transactions. And so some of these closures are to be expected, and frankly some of them were needed. So that's an element here. A lot of our clients on the phone here have been going to get the P3 stimulus money, which is going to enable the franchisees to be able to employ in greater staffing levels as hopefully the economy returns in the next 60 to 90 days. And, our hope is that a lot of that money is forgivable. We've been giving a lot of advice and counsel to clients on where to go for their P3 money and then what the forgivability aspects of it will be. The problem has been in the first round that you couldn't get the money. A lot of people can't get the money from national lenders especially. And so if you're on the phone and you couldn't get money the first time around, and you see in the news right now that maybe today they're going to do another $300 or $310 billion, you would be right to think that it's going to probably run out again in 4 or 5 or 6 or 7, 10 days. And if you are with a lender that has you in a queue, where you're sitting in a queue with a multiple electronic process, I'd advise you to go knock on the door if you have a relationship with a community bank or a regional bank that's going to treat you with a little more personalization and has better experience handling the volume of SBA and the complexity of SBA financing. That's just from what we've seen, those are the people who are successful in getting the funding. Government checks are going to provide an uptick for us. I think I talked to a couple of franchisees of Taco Bell who are friends of mine in the last week, and I heard a +7 over last year. I heard a +6. I heard a +13. One KFC franchisee that I talked to was flat over last year because of the government checks are starting to kind of trickle in, and it's having a nice impact on year-over-year sales. And so I'm a little encouraged about what I see there. I mean, clearly people are wanting to come out and go back to restaurants, at least on a drive-through basis. So that's optimistic in a sense. We have pockets of optimism across the country. I think it's fantastic that you're seeing a discussion about reopening the economy and reopening our country. And I saw 3 southern states, South Carolina, Georgia, and Tennessee, talk about putting procedures in place by the end of this week. Let's hope it stays safe, but that is going to hopefully get some areas and some brands back into the fold to maybe look more like a V-shaped recovery for them in those areas instead of a long U or a Nike swoosh recovery, right? And the last thing we're seeing is dropping commodity costs and wage inflations, and I think that's going to help profits over the long term. The price of a pound of cheese gone from $1.70 to $1.07. Everyone's been watching what's happening to oil and corn and soybeans. I mean, it's amazing how oil has dropped in the last day. So watch for dropping commodity costs having a really positive impact, even in the short term, but certainly in the midterm for franchise P&Ls. The M&A market conditions, this is kind of a bit of a busy slide. It's just meant to be directional. If you look at the slide from left to right, this is from December 2009 to December 2019. And you strip out some of the small categories like sub, sandwich, and then maybe also casual and family. What you're going to see here is a rising appreciation pretty significantly in valuations of franchise businesses from 2009 to 2017, right? And then you see a flattening roughly from maybe end of 2017, mid 2018 to today. And that's really what's been happening. You could probably layer in a lot of asset classes here, commercial real estate, maybe, stock market, whatever it would be, but a lot of asset classes have happened this way. We've seen a huge appreciation in the value and the price of franchise assets in a sale. And they were historically high. It's the highest I've seen in my career. And it's largely kind of treaded water over the last 18 months or so. Starting on March the 13th, which was really when we started feeling the major brunt of the changes in COVID-19. We had probably, Unbridled had like 15 to 20 deals that were active, and most of them have kind of gone on various stages of hold or elongation, right? We did have one 67-unit Moe's business sell. Biggest Moe's franchisee is a private equity group, bought them out of New York, and the deal closed the day before on like March the 11th or 12th, and just a tough situation for the buyer. But our hopes that business will come back around. But I think what we're seeing in our business is most deals have been elongated, by 90 to 120 days. And most sellers and buyers are kind of thinking about June 1st as kind of a time when they're looking at the market reopening and looking at their sales as hopefully rebounding. I do think that some of our deals, depending on the type of deal it was and what amount of drive-through business there was, will have a fairly significant impact and may not make it right now to a closing. But I think Mike and Reed could probably tell you the same thing about some of their real estate listings. We did have one business, it was a Papa John's business of decent scale on the market in the middle of the COVID-19 crisis. I don't know that this makes a real big data point for you, but we would typically expect to see 7 to 10 offers on a business like that, and we had 2. So the number of offers were down by 70%. And this process just finished about a week and a half ago. But the drop in pricing was only 5 to 10%. And I think that's telling, right? So there are buyers still in the marketplace, and they will pay fair prices, especially as we have a reordering, and the family offices and private equity groups tell me, hey, I'm interested now in pizza. I'm interested in Sonic. I'm interested in these brands that don't have a big footprint, or these brands that don't have a big exposure to the dining room. You're going to see less people coming to the table to buy them, but when liquidity opens up, I think you're going to see the ones that come to the table may be the most serious. And then we're recommending to our clients that they pause, new clients, that we pause until June 1st before we start reassessing when a good time to come to the market is. If we're working with you right now, we're continuing to work with you as you're working through the crisis. And maybe the process of due diligence, the process of asset purchase agreement negotiations, those kinds of things have been delayed a little bit, understandably. So here's the base case for a timeline from my perspective. Again, I'm just a hillbilly from Kentucky, but I've happened to be doing this a long time. I mean, my base case is this thing looks like a U recovery, right? Not a V, not a swoosh, but kind of a U. And in this particular case, if you look left to right at this graph, at this chart, I'd say virtually no new M&A activity in the next couple of months. I think that's not going to be a surprise to anybody. If you come down to July through September, loan modifications are going to be a big part of what you're going to see primarily initially in the future. It is true that 100% of franchisees who have a loan are going to have some sort of modification to their loan. Getting P&I deferrals for 60 or 90 days or going interest only is not going to be a permanent solution for you. And when you come out of this, you're going to have leverage that's just sometimes double and triple what it was in arrears. So all loans are going to need to be modified. That process is probably going to happen this summer and this fall. You're going to start seeing the first wave of store closures. When we go into August through October, I think you'll see an initial wave of bankruptcies and brands that really have been teetering, and these brands, you haven't eaten there in a couple of years, but you see some of their advertisements on TV and such. Those franchisees, will probably, some of them enter bankruptcy. And then I think you'll see some over-leveraged franchisees enter bankruptcy as well, maybe even in healthy brands. The reduction in store count will continue through this time frame, but I think that there's some positivity here, and there will be 2 types of initial upticks of M&A that'll start happening probably in the August through October timeframe. Again, it's anyone's guess, but this is what I think the base case tells us. The first thing is I get a lot of phone calls today from people who are, older guys who call up and say, Rick, I should have sold a year and a half ago, and when this thing gets back to normal and we can look at our trailing 12 P&Ls and adjust for this coronavirus, hopefully as some sort of a speed bump, I'm going to sell, even if the price is a little bit lower. And I've got a great business, and I'm tired of staying up till 3 in the morning looking at the ceiling over the last month and a half. So I think you're going to see a little bit of that at first, and you're going to see a little bit of supply and demand. So some of those good sellers that come out with great businesses, there's going to be very little supply, but there will be some demand. And so those businesses may trade at decent prices if we have liquidity in the market, which we don't know that we have right now. We're also going to see during that time frame, I think, a bunch of distressed deals kind of gradually start coming to the market. In November through January, my hope is that if you're a non-casual dining chain, you're going to be back to pre-coronavirus sales levels. Maybe this happens sooner. In an optimistic case, maybe this happens in the next several months. In February or March, I think when people get their year-end P&Ls and banks and franchisors look at that, there probably will necessarily be a new wave of bankruptcies. But under the base prediction, and assuming we don't have a crappy political climate and we're not in a horrific recession and geopolitical problems aren't persisting, trade wars aren't terrible, you know, blah, 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 all these kind of caveats. I think April, May of next year, once we have close to a year past the COVID crisis, I think we could see an M&A boom that would be massive. I mean, I'm talking massive. You're going to have franchisees who are going to have P&Ls that will have recovered, and you're going to have hopefully commodity costs and easing wage pressures. That's if we can get our employees back to work off of sick leave and unemployment, which is another issue. But we're going to have good-looking P&Ls, and I think the M&A boom will be there, and it'll be strong and furious. And the other thing is, I would give you comfort, having been through 2 of these before. Many of you know this, but in a deep recession, QSR especially typically does really, really well unless gas prices spike. That's the biggest corollary factor or correlation. And in this case, as you've seen, we might be below $1 a gallon here in the next couple of weeks or months. So that's not a real worry at the moment. I think this is maybe my last slide until I turn it over, but I would just point out a couple of things. A, segment leaders will prosper due to less competition. Store closures, if they hit 10%, you're going to see a lot of people close restaurants, and the cream will rise to the top. It always does. The strong will get stronger. And B, the brands with high premise sales will recover sooner. Obviously, that's an obvious comment. You look over to the right and you see some of the brands. These are just directional numbers. They're not meant to be exact, but you can see the brands have, as an example, really high off-premise and then really low off-premise, and that's going to be a challenge there for the ones that are low. EBITDA multiples in the base case would probably drop, in my view, somewhere between 1/4 of a turn to 1 turn of EBITDA, but I think that's really devil's in the details. It is possible and true that a Sonic business, as an example, or a Papa John's business might actually increase in EBITDA multiple as we have some sort of a reordering of what buyers want to buy. I get these phone calls now from family offices saying, we want to get into pizza, we want to, you know, like I've been telling you. You know, in the Taco Bell brand, you have 30 buyers for every seller, so it's unlikely you're going to see a massive EBITDA multiple drop there either, especially when liquidity comes back to the market. But in some of the brands, like the casual dining brands and maybe some of the languishing QSR brands, you may see a massive EBITDA, you know, repricing as an EBITDA multiple. Fewer lenders will emerge. We probably had 25 or 30 of them specializing in the franchise business prior to this. 4 or 5 had come out of the business or had paused making new loans. Credit will be squeezed some, and I do think you're going to see less lenders than before. And so lease adjusted leverage, which is a key metric used to recap a business and buy businesses, will drop. And what that means is people are going to have to likely investors are going to have to put more equity into a deal. The other thing though is we have the 10-year at like 0.5% today, which is the lowest. I don't know, it might be the lowest in 100 years, who knows, but it's the lowest I've ever seen. And so borrowing costs are really low to maybe combat the lease adjusted leverage issue. In item F, you've got normalizing P&Ls. So, you know, there are 2 ways your business is valued, right? I mean, 2 things that really affect it. Number 1 is going to be what your EBITDA is, and the other is what the EBITDA multiple is. And one multiplies the other, and you get to a valuation. So the multiple is one thing, but what is the EBITDA that we are going to use for evaluation purposes? And the quicker the recovery, the more we're going to be able to normalize all of it or most of it as a speed bump in arrears, right? And just normalize the P&Ls. I was talking with a lender who was saying just preliminarily that they thought they would take, for purposes of financing a transaction, they would look at right now they would look at 2019 full year P&Ls and make like a 5 to 7% sales discount. They're making a loan. That was an interesting comment from this particular lender. More to come on that. We should expect the M&A processes to take 60 to 90 additional days. I would say, you know, when you're dealing with lenders that are going to be kind of haywire, and you're dealing with landlords and you're dealing with franchisors, it'll just take longer. Our average deal has been averaging 5.5 to 6 months on average. I think earn-outs and seller financing will become in vogue again, so watch out for that. That happened in the last 2 recessions. For a buyer and seller to kind of come together on a price, there have to, you know, sometimes in the middle you have to be creative. And the last thing I would say in I is that store closures are going to help profitability. A lot of franchisees, some of you are 200 unit franchisees on the phone, and I bet you're already looking at closing 10 to 15 to 20 of your stores, right? The ones that are at the bottom of the pecking order and aren't doing well. So that is going to help profitability, and remodels and development obligations are going to be slowed or wash away. I think that's a positive for the industry too. You know, some of these development obligations have been crazy over the years. So that's going to help, I think, the capital outlay in the business going forward. So watch that with your franchisors. And then with that, I'm going to hand it over to these guys, Mike and Reed. You guys fire away. Thanks so much.
Great. Thank you, Rick. So leading up to, call it pre-COVID, we had a real estate market that was firing on all cylinders. I'll kind of break it up into three distinct buckets. First being portfolio sale leaseback market. So, call it 10 plus properties where you're either selling simultaneously to an acquisition or, you're selling existing real estate to create liquidity. The other being, your private market, one-off individual sale leaseback, typically kind of runs along a development process in which you're selling, onesie twosies into the private markets to 1031 exchange buyers. And then the third being the structured finance market, where we're getting highly levered interest-only debt secured by a propco entity. And we'll touch on some specific examples in later slides, but ultimately we started noticing this change really in mid-March, around the same time everyone else did. And much like the M&A market, professional buyers and private buyers all turned to their existing portfolio to figure out how deep this crisis was and what the direct impact was, and really, how much rent were they going to get come the first of the month. And as far as active deals, we had quite a few larger M&A deals in process right in the middle of COVID-19. And we've seen, quite a few retrades, and we'll touch on this later. Rent guarantees, escrow holdbacks, prepaid rents are becoming almost a daily conversation on our larger portfolios. And same even in the individual markets with private buyers, their lenders are kind of forcing the buyer's hand into getting some of these things as well. From a timing perspective, we also mimic that of Rick's business and what's been transpiring in M&A. Typically, right in mid-March, everybody started saying, we need 30 days. And then really 2 weeks later, or even a week later, they said, we're going to need 90 days. It was this kind of like gradual progression of like figuring out how bad this actually was. And here we are today looking at, 22 million unemployment, and it's just unbelievable what's transpired in the last 45 days. So things are pushed off, lenders are pushing off, buyers are pushing off for the vast majority of transactions we're working on, with a select handful of tenants that are actually faring relatively well and can still transact in this market. When it comes to actually marketing properties, whether you're marketing a portfolio or you're marketing a one-off, it's much the same in that you need to get out ahead of people's concerns by way of addressing this period of time and trying to say, things like we'll hold back money has become a part of the conversation. As brokers and representing our clients, we want to take one thing off the table, and that's the guaranteed stream of income. And we say to our sellers, let's put up 3 months of escrow money so that we can get that 5 cap, as opposed to them coming back and wanting a 6 cap. So we focused our time and efforts on making sure that buyers feel comfortable that they are in fact going to get their rent during this crisis. Rick, if you could just go to the next slide.
And by the way, I'm getting a text, that just came in that said the one franchisee was up 22% last week in sales. Pretty fantastic, right? So they're in the Southeast. Wow. Yeah.
We've been hearing the same thing, especially like, in the pizza world. I heard the same thing on Sonic. It's very interesting to see some of these groups really benefiting. Reed, you can go ahead and tackle this slide.
Sure. So, let's get into how COVID-19 has affected real estate valuations and what we've been seeing specifically in the real estate market. So we'll start by talking about what's happened to cap rates. Leading into the crisis, as Mike mentioned, we were experiencing very high demand. Pricing was at the top, and it has been for the last couple of years. Velocity was very strong, and most opportunities you're sourcing multiple offers and getting the best terms possible for the seller. So it had been business as usual, and cap rates were stable. Today, there has been a pullback in demand and velocity, but cap rates, we haven't seen them slide significantly for most assets. That pullback in demand, however, has started a trend of offer terms that have been slightly in the buyer's favor. And perhaps there have been a small haircut in pricing depending on the fundamentals of the lease terms and the real estate for the offering. Buyers today seem hyper-focused on the security of the investment. They've started asking for specific terms that are going to provide them with additional security, like rent guarantees or escrow holdbacks from the seller. And we're also seeing them ask for additional time for due diligence and for closing, in part because of borrowing timeframes. So leading into the crisis, interest rates were at historic lows. In early March, there was a significant push of landlords to refinance their existing loans so that they could capitalize on those historically low interest rates. Many borrowers were able to get that in time and are now enjoying those rates. But then as April approached, concerns started growing amongst the real estate community surrounding the rent deferrals and requests for rent abatements and how that was going to affect mortgage payments. So many of the lenders turned inwards towards their own portfolios of loans and started providing solutions to existing clients surrounding rent being deferred on many commercial assets. So at the end of March, most lenders ended up putting a halt on new loan activity and started saying that they were not going to be issuing new loan commitments for 60 to 90 days or more as we understood how the crisis was going to unfold. So today, that dynamic is largely the same. Lenders have started to scramble to work with their clients on some of the government stimulus programs like PPP and are still really dealing with the consequences of those rent deferrals and abatements with their existing clients. So new loan activity is largely at a halt. Those rent deferrals and the shakiness with restaurants has also drawn a little bit of an attention on buyers to certain fundamentals of real estate and has caused a little bit of a flight to quality in some cases. So regarding geography, demand does seem to have been impacted more in difficult geographies or smaller geographies. And, we typically see that when the market is shaky, there will be a flight to quality. And where we're seeing buyers turn is those deals where there's strong underlying real estate, there's a large franchisee credit that's backing the lease. They're turning more towards those household name brands rather than more regional concepts. And then they're looking for really sound real estate fundamentals like low rent per square foot. So, if today you're selling, say, a Taco Bell in Phoenix, you probably haven't experienced much of a change in demand on the real estate sale. You're probably still getting multiple offers and pricing and terms probably haven't changed much. But if you're selling a smaller concept in a secondary or tertiary market, you may be getting a little bit less interest and less buyers at the table today. And you're probably seeing a little bit of a delta in pricing as well. And that segues kind of into changes that we've seen in buyers underwriting. So, they've become hyper-focused on the security of investment. And what's come along with that is buyers are becoming very focused on what market rent is and market price per square foot. And we're having buyers come to us and ask for comps to show that, the rent and the price per square foot that we're marketing at are in line with market, and that in the event of a downturn, their restaurant's not paying twice market rent and is not going to be able to pay the same rent afterwards. So, we're having a lot of buyers ask for those types of comps and then also ask for financials and sales performance to see kind of how restaurants have performed the last couple of weeks. 1031 buyers and repricing. So it's important to note that 1031 has been extended to July 15th. So 1031 buyers have become a little more patient. They have 3 months to identify, and that's caused them to really kind of focus on good real estate and look for a deal. I think that trend will continue, but they'll start to feel the pressure a little more because there hasn't been as many properties hitting the market, and all of the good deals should dry up soon. So I think that they'll get more motivated as time goes on. And then, the REITs, some of the REITs have pulled back or are even out of the market because they're turning towards their existing portfolios, or maybe their stock price has taken a significant hit. So their cost of capital has risen and they've pulled out a little bit. But other REITs are filling the gap in the market, and pricing has largely remained the same in the REIT market, although we're getting a little bit more buyer-friendly terms, which Mike will touch on soon.
We'll spin to the next couple of slides if that's okay, you guys. We got maybe 7 or 8 minutes to go to hit it. I'll just say as I'm seeing this, I'm seeing text messages and things come in pretty cool, right? Like one guy's telling me he's a Arby's franchisee, he's up over 20%. 2 KFC franchisees are up between 20 and 30%. Sonic franchisee is up 22% last week. I'm hearing too that we are rolling over Easter this year, no Easter, last year Easter. So there's some impact there. but sorry to kind of get in your way there, but just some actually some pretty sweet news, right? It's awesome. That's what we all want. It's awesome.
Yeah, that's great.
Yeah, go for it.
So I want to touch on kind of the two main buckets that you look at from a sale leaseback perspective, i.e. the portfolio market, which is on the left, and the private market, which is on the right. What we're seeing in general on the portfolio side is anywhere between a 25 to 75 basis point increase to cap rate, with an extreme focus on making sure that a tenant's going to be able to pay their rent for the next year, or for the remainder of the year has really been the most common discussion we've been having. So they're doing that by way of escrow holdbacks, prepaid rent guarantees, you name it. We've heard all of it from the institutional buyer pool. And it's not just REITs, that can be private. I've seen a lot of private equity firms and family offices step in and kind of pick up a lot of the demand that's been diminished by the institutional capital. So, we've been negotiating constantly on these terms. The professional buyer pools turn their focus to extreme amounts of liquidity and extreme focus on liquidity and credit. So that's become ever so more important in today's conversation. And a real deal example that we were working on pre-COVID that was in escrow, the buyer hadn't removed contingencies, a 52-unit Burger King business, $6.6 million of EBITDA, 24 fee properties, which is our part of the equation. Pre-sale leaseback, we were at a 6.15 cap with 1.25% annual increases under a master lease. Pretty market, right? Burger Kings are anywhere between a 6 to 6.35 cap as far as the portfolio market, so 10 plus properties. They came back, they retraded us to a 6.75 cap. We said, okay, we'll see you later. We feel we had already touched base with all the buyers in the market and felt good that we could at least execute it at a 6.50. We went back to market, and that same buyer ended up coming back non-refundable and closing with no rent guarantee at a 6.35 cap rate. Now that is the better portion of the examples. There's been plenty of examples of deals dying as a result of a blanket retrade by a buyer. But I'm happy to give more examples and follow up if people have questions, brand specifically, because each brand is definitely being treated very differently. Going off into the private market, the sale leaseback market, you're looking at pricing changes between 10 to 35 basis points for the most part. Again, touching on what Reed said, a flight to quality where buyers and lenders are really looking at underlying real estate and rent per foot. There's been an extreme focus on rent per foot. As soon as it gets over that really $60 per foot mark, you start seeing leverage come down, which affects the buyer's ability to seek leverage and pay a lower cap rate. Quick example, 65-unit Taco Bell business. They're building one-off Taco Bells. We've been selling them between a 4.75 to a 5.15 cap rate. Had one under contract. They retraded us 35 basis points. We ended up getting it done at that price, but gave them a 50% rent concession to our client for the 3 months following the closing. So ultimately, still pretty good execution given the existing scenario.
Yeah. I'm just also thanks, Mike. I'm just kind of looking at some of the comments too, just throwing them in here as we talk. But we had a franchisee sharing that they're up 19 last week. A Wendy's franchisee saying they're down 12 to 15%. I don't know if that's last week or just now. We've got some folks talking about distress and in certain areas of the country as well. So it seems like it's all over the board. But I just wanted to share that. Yeah, I know we have another slide here, so go for it.
Yeah, and this is really the structured financing market, which maybe not everyone's in tune with, but part of the reason, I'd say one of the main reasons why multiples have been supported to the extent that they have been is because of the ability to finance and sell real estate. Real estate's become such a huge part of the M&A process. And, pre-COVID, we were obtaining 65, depending on the brand and the quality and the leverage on OpCo, we were generating between 65 to 75% of appraised value. And now keep in mind, appraised value is dictated by, because you would own the business and the real estate in separate entities, you can kind of control those metrics and increase leverage drastically. So we did a lot of transactions in which we got 100%, 110%. There's people on this call, we got 110% leverage where they use that money for OpCo in an acquisition, 4.5 to 5.5% interest only secured by PropCo, so it doesn't affect OpCo leverage, 2 to 3 year term, no prepayment penalties. You're basically buying 100 Taco Bells, and then you're selling them off individually, and that's what you use this structured financing for. This market has really shut down. It's one of the few, not one of the few, but one of the main markets that's been extremely negatively impacted by this situation. And now lenders for a, call it B brand, are looking at 50% leverage and things of that nature. They're also asking for time. Anybody that was in the midst of a transaction lender-wise, that really wasn't at the tail end of it, is asking for a minimum of 60 days and typically more like 90 to 120. So, for the right brand, the right sponsor, the right deal structure, there's still 65% of appraised value out there. In fact, we're working on a deal right now with a top tier brand where there's only 50% leverage on OpCo, and everything's kind of like, and the business is only off by 7%. And we are obtaining excellent financing in that realm. But for the most part, this is changing the decisions that are being made on real estate. So it's very important, if you have real estate on the books, or if you're buying a business, or if you're selling a business, you need to reevaluate what you have today, because it is different. Things have changed. You need to reallocate rents and change the way in which you're underwriting your real estate portfolio. So that's it for this slide.
Yeah, that's great. I think that's fantastic. I think I'm just looking at the time, guys, and we got about maybe 15, 20 minutes left, but instead of maybe doing the Q&A, I think we'll just kind of keep on going. Does that sound okay? And we'll try to address some of the questions that have been sent to us. So, I'll just thank you so much for your all's thoughts. They resonate with me, and I'm just going to make a quick comment on thoughts on the turnaround. In the base case, I talked about it from the franchise side of the business, and someone came in saying if my comments are just for the food business, or they also are with fitness or car care or with healthcare or beauty care businesses. And I just say, kind of broadly speaking, my comments fit all of the franchise businesses. That's a broad comment. I think the fitness space particularly has had a lot of leverage and a lot of high multiples in the space, and has had a lot of positivity over the last few years particularly. And we're gonna see what happens from a revenue perspective when everyone gets back out, and how the fitness space is affected. I'm not too sure I have a good answer for what will happen with the revenue recovery in those concepts. But my comments do really pertain largely to franchise businesses as a whole, and not just food franchises. The base case, I think, though, is a U-shaped recovery, right? The best case is a V, and then I said the worst case is kind of maybe a swoosh, an inverted swoosh, maybe. There is a worst case scenario here, and a worst case scenario could be 2 or 3 years of no credit, and so, but I don't think that's what's going to happen. I would point you to your staffing levels, your AUVs, your profitability, your franchisor relationship, which you should kind of reinvest in, and your lender as areas of concern and areas that you need to be on top of as a franchisee. Bringing back and training employees is going to be a challenge. It's okay right now as I drive through the McDonald's drive-through and wait 10 minutes to get my food. I understand. But what's going to happen is the best companies, when we open back up, are going to be treating customers better than that. And when they treat customers better than that, and you can go through with a 3-minute drive-through and people are friendly and giving you good customer service and great product, you are going to win. And the 10-minute drive-through isn't going to cut it anymore. So bringing back and training your employees is going to be a big challenge. Will the staffing? How will we staff the pent-up demand that comes out of this, especially on the QSR side? Will better hiring markets present themselves once we get past the sick leave and the unemployment government stuff? Will there be less wage pressure going forward? And hey, maybe some of these states might relinquish some of their stronghold on minimum wage increases. We'll have to see how the political situation kind of happens. And then we talk about the commodity cost favorability being a big part of these consumers' businesses, of your franchisees' businesses, that I think is going to maybe offset some moderate sales declines. And if sales get back to pre-coronavirus levels, may actually produce a better looking P&L. We talked about the need for loan modifications in this next phase. And again, better operators are going to excel and tighten the ship. I think that will happen. And then let me see, I'm going to go forward one more slide. This is the last slide before we take questions, but we're going to see new brand winners emerge. The restaurant business has been kind of a slow changing industry, right? And so we've started to see ghost kitchens pop up and delivery being more of a staple in the industry. and new types of food, different footprints of businesses. And I think new brand winners are going to emerge. So watch out for the innovation and the American entrepreneurship spirit, right? I mean, that's what started franchising all these years ago, and it'll continue to evolve and in the future and produce new brand winners. Best brands will get even better, no doubt about that. Restaurant closures were badly needed as a result of overdevelopment. So maybe that will have a positive 5 or 6% sales impact on some of the best brands that are sitting next door to several franchises that might close. Independents, fast casuals, and casual dinings will be the general losers, unfortunately, I think. And probably in an outsized capacity, we could see wholesale brands not make it clearly over the next 6 to 12 months. I think, and Mike and Reed look at me and probably think I'm crazy, but I think restaurant real estate becomes both much more important but also less important. And you're like, Rick, what in the heck does that mean? I mean, clearly the value of being at Main and Main from a drive-through perspective is going to be there and be there more than it ever was, as drive-through business and delivery business is more, and carry-out business is more of a big deal. But I would also say that as a lot of these clients and friends of mine have QSR restaurants that are big old behemoths on 1.5 acres of land with huge dining rooms, and they're only pushing 15% of their business through that dining room. What does that tell you? That tells you that maybe you only need 3/4 of an acre of land and you only need 10, places to sit. Maybe we come out of this and Americans make a permanent change. I mean, we can't even remember what we ate for breakfast this morning, so I don't know if that'll happen, but it is possible that we'll make a permanent change and we won't eat in at QSR restaurants or at casual dining restaurants as much, even a year or 2 years out of this. I think and for that perspective, maybe restaurant real estate becomes maybe different. I don't know that it's
and to add to that, Rick, you have another component of this is that, you're really talking about the single tenant net lease market, right? We focus much of our time on restaurants, but as a whole, there's so many retail bankruptcies, so many less tenants that a buyer, a private buyer especially, and even an institutional buyer will look at and say, I'm comfortable with this and this is going to be around in 10 years. So the supply is shrinking, which makes restaurants more competitive just by nature. Take out what's happening right now. That's already been transpiring for years. So that's another component that will add to the value of real estate. Not to say that values are going up, but it's helping combat some of the negatives that are happening on really the credit side.
Yeah, it's a good point. It's a really nice point. Jumping back to the list, I guess I would just say that, there are several brands, and those of you on the call probably know the brands that are like this. Maybe you operate in these brands, but there are several brands were previously unattractive, right? I mean, just from this standpoint, you buy 20 restaurants and you got to sign up for a 50-unit development obligation. And you can't close any of your restaurants because even if they're negative $100,000 in EBITDA, you can't close them or we're going to sue you, the franchisor says, or something like this, right? So those types of conversations are going to loosen. The franchisors, especially the ones that are publicly traded and have they're going to have the ear of the shareholders, and they're going to have cover now to say, well, golly gee, we have the coronavirus here, and we can't help it that we're having to ease on the development requirements that we previously promised to the street, and we're going to have 500 more closures in our brand than we said to you earlier. So it provides a little bit of cover in that way. And I think that's going to bring people back to brands that maybe were a little bit too big for the britches, actually. You know what I mean? And I don't know how else to say it as a Kentucky boy, but some of these brands thought they were too cool. And so they're going to have to be forced to be more reasonable on the franchisor side. And then I think we're going to have pockets of success coming out of this, but we will see an increase in, workouts and bankruptcies as we go through it. I want to take some questions, I guess, now. And I don't know if you guys can see this on the screen. Mike, can you guys see this on the screen as I kind of pull up some of these questions? Maybe you can't.
I've got the webinar chat up. I can see.
You got it up.
Yeah.
Here's one. Thoughts on the future of buffets, Golden Corral, et cetera. This is one question. I'm probably best suited to answer this one. I would say, buffets bother me. They just bother me coming out of this crisis. I hate to say it. I think it's a format that's highly likely to be unattractive to the family office and private equity world going forward, because a lot of the people that manage those funds in those companies are young 30s, and those types of folks really don't eat at buffets anyway. And I think coming out of this, they're going to fall out of favor. That'd be my short answer. Of course, if you have a profitable business that's a buffet-based business and it's really good, and it's in a great geography, then I would punt on my comment there. Let's see. We had one question that came in that was.
I've got one here. Oop, there we go. Got some feedback there. That's weird. Regarding private lenders entering the structured financing space, as I was talking about, we have seen a little bit of that. We actually, about 4 years ago, there was 2 lenders operating in this highly levered real estate structured financing space. And our capital markets team went out, and actually now there's about 20. And we were a part of kind of opening it up to new lenders. And so we're in the process of doing that again. And we are seeing a couple groups have come in and have issued some term sheets on deals that were not around, frankly, or as competitive a few months ago. So that is happening. It's been more private equity than anything, but there are some groups coming in to start filling the space. It just depends on what it is and the size. Size becomes a bigger deal when dealing with the private lending space. But that's a great question.
Oh, I see some great questions here, man. I could talk for hours on this stuff. You guys who know me know this. So I'm just looking at these. I'm like, oh. So here's one. Thoughts on mod pizza specifically? Okay, I'll give you my thoughts on mod pizza. Mod pizza fits into a category of fast casual. I don't like fast casual in general because if anyone could walk into a fast casual location and count the number of employees in the back of the house and see that there's way more employees than a QSR establishment, right? The other thing I don't like about it is the high food costs and the incredibly high leases at strip center locations that they're paying to be in those locations. So a lot of my friends and clients are big franchisees who have small fast casual businesses. And those fast casual businesses are being protected by their larger businesses. And people don't really know how poorly some of these fast casual businesses are performing. Not to mention the type of customer that they're appealing to are a fickle customer in general. So I'm not going to make a comment specifically to mod on that, but I would just say mod fits into a bucket of fast casual businesses that I think are going to be in trouble. And I think they're going to be in a lot of trouble. I think you're going to see QSR tearing and ripping revenues from them going forward, unfortunately. Okay, do I see franchisors stepping in and owning stores again? Wow, wouldn't that be crazy? I mean, we've got all these asset-light franchisors now. I mean, I guess Arby's isn't. There are some that aren't, but most of them are. You've got a lot of franchisors who have 5 and 6 and 7, 8, 900 unit franchisees, and there's one in the pizza space that obviously isn't performing really well right now. So, what will happen there? I think I would say this, I haven't thought about this a whole lot, but my comment would be this, and franchisors are going to protect their brand. So the first thing they're going to do is if there's massive distress, but I think generally speaking, they'll try to give the franchisee concessions that would be concessions they wouldn't give to anybody else in the franchise system to try to keep those locations in those geographies open. And then if they think the franchisee is a strong performer. If that can't happen, I think the franchisors are largely thinking last resort for sure. But I have seen franchisors step in, like Pizza Hut in 2009 and 2010. They stepped in the Midwest on several transactions that I was working on that were in the bankruptcy court, that they ended up taking restaurants back, operating them, doing the remodeling, renegotiating the leases, taking them from dine-in to drive-through, carry-out assets, Delco assets, and then refranchising them when we got out of a recession. So I think that's possible. Sure, I think it's possible, and I think you're going to see it if it happens in the brands that have been struggling for same-store sales performance over the last several years. That's a question. How about this? We had one on should you sell now or wait for a year until your EBITDA improves? Ooh, that's a good one. I can take that. Do you guys want to maybe make a comment on that from the real estate side first? Anything, should you sell now or when should you sell if you're looking to sell your real estate? Do you wait? What do you do?
Part of the answer to that is it depends on what it is, which brand and the existing status of the business. Are you shut down or are you treading water? Are you bleeding? Some of those things. But if you have a business that you're able to operate and you've pushed off some expenses and maybe revenues are off by 25, 35%, I would still argue that right now, if you own real estate, it is the time to liquidate because things are only, I believe things are only going to go down from here, and there still are buyers willing to pay relatively similar pricing depending on what it is, the size of it, and the credit behind it. So it just depends. You know, I always kind of veer away from giving an all-encompassing statement because, you know, we have clients right now with prime businesses that are doing well, in which we're selling all the real estate. You know, they basically had been building up a portfolio, and we're executing within, you know, 25, 35 basis points on a cap rate basis, and actually dialing back rent. And that's a big part of what needs to transpire here is a rent allocation analysis. If you do own real estate, you know, the value of rent in different markets, as Reed touched on earlier, is drastically different. So you don't want to have necessarily, if you're going to sell a store, all this rent loaded up on a tertiary location when you could move more rent over to a more primary location and generate more proceeds. As long as, you know, rent coverage and cash flow in the business on a four-wall EBITDA basis or EBITDAR basis is commensurate to the business, you know, succeeding long term. So it really needs to be a lot of analytical work done on the real estate side in order to really create a strategy that's going to make you most effective. But for the most part, I'd say, you know, 6 or 7 out of 10 times we are in fact executing a disposition process for groups that are do own or are developing real estate right now, because what's going to happen is you're going to see a ton of supply come online the same way you're going to see a bunch of businesses come online at the end of the year. Same thing's going to happen with real estate. A bunch of people are just saying they're not going to do anything. And I would avoid that and try to go now when supply is limited and there's still a decent amount of demand.
Yeah, I think you and I feel the same way about that in a little bit. Like if you're, you know, I said it kind of the same way earlier. I mean, from an M&A standpoint, I mean, I don't know that I have a clear answer to the question, because it is true that some of the brands are actually performing better on a sales basis in the crisis. I mean, I want to be sensitive to the people who are really struggling out there who are listening to this. It is also true that people might be down 10% in sales, but their commodity costs are going to be incredible, and they might have even EBITDA. It is true that maybe there'll be some reordering of brands, and maybe some of the brands that weren't trading as highly valued could bump up an EBITDA multiple. So waiting in those cases might not be a good idea. I mean, if you have a business like a Taco Bell business where there's 100 buyers for every seller, I don't, you know, I don't know that you're going to see a ton of change in the market as soon as we have more liquidity, which you know, who knows when that'll be. You know, if you have a business that's going to struggle, you may not have time to wait a year to sell. But for the rest of, if you're just a franchisee who, you know, if you're just a franchisee out there that's not over leveraged, that you're not in one of these brands that just everyone wants to buy, I guess I would tell you this: look at the type of recovery we get. If we get a V-shaped recovery on the franchise side, whatever type of business you own, your business particularly, if it comes back quickly, I, as an M&A advisor, can say to buyers and to lenders that this is a speed bump in our trailing 12-month P&Ls. And if it is, we can normalize a lot of it. Now, I mean, I don't have enough data right now to test that theory in the M&A market because the market's shut down. But I would say that this looks like something that's a hiccup in the past, much like a hurricane or, you know, something like that might impact P&Ls for 30 or 60 days. But if we have a longer U-shaped recovery, it becomes much more difficult to do that. And I think the longer it takes to get back to the status quo, I think the more impactful the drop in the business would be from a valuation perspective in the near term. There's do you want to go add a couple of more? I think it's almost, we got a couple more minutes.
Yeah.
How about, okay, here's one. I've had at least 3 or 4 family office private equity groups call me, like I said, on chicken and pizza specifically. Now, I know I do a lot of yum work, right? Or Unbridled does a lot of yum work, but particularly chicken. And let me tell you, the chicken space. So the comment is, what do you think about the chicken space? And my comment back to you is, I think that the buckets of chicken and chicken and sides has always traveled really well. It's very appealing to eat that product after it's been delivered. Kind of unlike French fries, for example, which don't really hold as well for as long of a period of time as coleslaw would, right? So I think if we come out of a largely drive-through economy coming forward, and we have a lot of delivery and places like Uber Eats and ghost kitchens are kind of going, I would say that the chicken and chicken on the bone, which has been going through a kind of a casual nosedive for the last 15 years, may actually become a little bit more appealing to to people, to buyers, to consumers. So I'm positive on chicken. I really am. I think chicken is a place to be. How will Jersey Mike's pull through this? And then how will Moe's pull through this? I guess I would say this. I've always kind of felt like the sandwich business was heavily competitive. I mean, if you go to any major city on our street corner in Louisville, Kentucky, you see every single sandwich chain right next to one another. There's no way all of them will make it. There's just no way all of them will make it. So I know personally a lot of friends who own sub sandwich franchises that aren't doing as well. I like Jersey Mike's though, and I think again, if you hang in there long enough and you provide great customer service to your customers, and you have a great product that's differentiated. If someone can say in 30 seconds or less, why do you like Jersey Mike's? And there's a really compelling reason. Like someone said to me, why do you like Taco Bell? I say, it's a national brand. There's no national competitor in Mexican QSR. They have incredible a marketing genius, and they've got great new products that are constantly coming out that grab my attention. Okay. That's a real easy and quick way I can say why I like Taco Bell. If I could do that for Moe's, and if I could do that for Jersey Mike's, and I think I can, then my comment coming out is that they're going to struggle because they don't have drive-throughs, but when the recovery does come back, they're looking probably to take market share from others around them. I don't know. Some of you may disagree with me. I don't know. I'm talking fast and just sharing my thoughts. What else do you see out there? Yeah.
There's a good one. What is your answer when the asset managers and sellers bring up the panic selling objection? I think what you mean, what you're talking about is the buyers thinking that maybe you're kind of just trying to sell real estate to try to raise as much capital as possible before, a bankruptcy event or something of that nature. That just comes down to financial modeling and creating a clear path to profitability and weathering the storm. And that's just preparation work. We work alongside your accountants to make sure that we're prepared for that out the gates. And it's also framing the conversation correctly. And everyone to some degree realizes that this is a cash crunch, right? So we will tell the buyers that this is why we are selling real estate assets to create liquidity so that we can weather the storm. That's perfectly normal. It's part of everyday conversation with the buyers of real estate here. And doesn't have to be, but that's typically the framework. And at the end of the day, if the pricing's not there, we just don't move forward, and we can look at financing or some other alternative route. I hope I answered your question. I'm seeing it. I'm just gonna see.
I think we've hit an hour, and so I think we probably ought to. I'm just checking here.
Yep. On the dot.
Who's this? Is somebody who's up a bunch? Good. Someone here who's in the Burger King space who's up a lot over last year. Great on the West Coast, actually. So, we want to be sensitive, of course, and to everyone and their personal circumstance. I personally, want to thank you guys for being a part of this. I know Reed and Mike would say the same thing. Our thoughts and prayers go out to your families and loved ones for safety. And let's hope for this darn thing turns around, and let's get back out there, man, and make it happen. And many blessings to you. Just follow. If your question wasn't answered, we will do our best to reach out to you personally and answer. And we'll get a copy of the audio and of the presentation out to everybody who signed up for this Zoom conference. And again, go to the website if you want to get our emails. And 2 weeks from now, we're going to be hitting it hard with business interruption insurance, which again, after COVID, after P3 loans, I think is the next shoe to drop. There's going to be a lot of people who have claims that are going to get rejected. And I think this is going to be important for you. So many blessings, and thank you so much. Thanks, guys. Thank you, Mike.
Thank you, everyone.
Thanks, everybody.
Yeah, certainly. Everyone have a great week. Thank you for your time.
Yeah, cool. Y'all be good.
Thanks, Rick.